Hi, I'm James Robinson, and this is my stock pick of the week. Today we're going to look at the company Manpower and its ability to create wealth for shareholders. There's a number of ways that a company can do things to create wealth for the shareholders, and so we're going to kind of go through those sort of one by one. The first thing that a company can do to create wealth for its shareholders is to repurchase shares. And you can see that since 2005, this company has basically bought back shares every year. A couple of times in the recession, it went the other way, but effectively they bought back shares every year. And when a company buys back shares, that means you as a shareholder own a larger piece of the company, and you also get a larger piece of the profits. So the rebuying of shares is a way of creating wealth for shareholders. And this is something this company has done consistently, and appears that they will continue to. In fact, just this month, the company agreed to buy another, I think, 1.8 million shares of stock, or I say the board of directors approved the right to buy another 1.8 million shares of stock in the event they think they can do so at fair prices. So this is a trend that we believe will continue for the company. To put the share repurchases in context, if you'd owned 10% of Manpower at the end of 2008, you'd have had about 7.9 million shares of stock. Through stock repurchases, your 7.9 million shares of stock would mean your ownership in the company today had gone from 10%, which it was in 2008, to 12.78%. So you've had about a 27% increase in your share of the company. You didn't do anything, you didn't spend any money. The company's bought back shares and made you that much a larger piece of the owner. To put it in further context, the company's earnings have gone from negative $920,000 in 2008 to 70.86 million. That's your share of the company earnings in the last 10 years. Now, it's a little bit artificial because if you remember in 2008, we were going through a recession, and the company had been doing much better in 2006 and 2007, but we use these numbers. But effectively, your share of the company's earnings have gone up. The company's earnings have gone up. Your ownership in the company has increased, and so you've got sort of a double whammy in terms of value created for you as a shareholder. Another thing that a company can do to create value for its shareholders is to increase shareholder equity. This company hasn't done that, and they haven't done that because they paid so much in dividends. They paid back money paid back money in dividends. They paid back money by buying back shares. So that's what they've chosen to do with the money instead of increasing shareholders' equity, and that's fine. If we can use the same amount of equity and increase our profits every year, then that's wonderful as a shareholder. We like that. We don't want the company to hold equity that they don't need and can't utilize profitably. Another thing that the company does is we look at what the company is, the company's return on assets. So the company needs a certain amount of assets to run its business, right? They need equipment, they need facilities, they have to have reserves in the bank. And so those are assets that the company is hopefully using productively to create value for its shareholders. This company's return on assets is not as high as we'd like. It's about 5 or 6%, but it's in the top 25% of companies, and so we're okay with it. We don't give it a 4-star rating in this category. It doesn't do a great job in terms of return on assets, but it does a better than average job. When we look at everything else, we're willing to overlook the fact that this isn't a 4-star rating. So return on equity is the same thing as return on assets, only we include the fact that the company has debt. So they might have $100 million in assets, but they have $50 million in debt, then they have $50 million in equity. So you can see that the return on equity for this company has gone up every year since 2012. It's now better than the top 25% of companies, so it's good and getting better. And so we appreciate this company's ability to create wealth through its return on equity. The next category is retained earnings. So when a company makes a profit, it can pay dividends, it can buy back shares, it can pay down debt, or it can retain it for future use in their operations. And so we like to get a sense for how much the company has to use in retained earnings. Retained earnings really haven't changed much since 2011. It's gone up, but it's gone up only marginally. It's less than $500 million a year. For companies of this size, they're not retaining a lot of earnings, and so that's a good mark. And you're going to see in a minute how well they've been able to utilize those retained earnings to create additional income. So the next category is return on retained earnings. And this is what we're trying to figure out here is if a company is going to withhold a certain amount of money in retained earnings, they should be able to utilize that money to create additional earnings. If they're not doing that, then they're really wasting the money, right? And so what we do is it's an oversimplification, but we just want some gauge. What we do is we look at how much money the company's retained in the last 10 years, And then we look at how much income has increased in the next 10 years, and we simply convert that to what's the return on investment for that money. We like to see 10%. You can see that this company, generally speaking, is north of 10%. There's been 3 years in the last 20 where it hasn't been north of 10%, so pretty solid. And it's been above 20% for the last couple of years. So the company seems to do a good job in the long run of converting retained earnings to profit. And so we don't mind if this company could continue to earn 20% on the retained earnings. We'd want them to stop paying a dividend, stop buying back shares, and just retain earnings and effectively put it to work. So we're very comfortable with this company's return on retained earnings, especially over the long haul. So this next slide looks at total wealth created. What we've done is we've simply said, what's the amount, what's the average annual change in debt? When a company pays down debt, we look at that as enriching the shareholders. It's less obligations we have to pay. We look at dividends. Obviously, dividends are money that goes directly to the shareholders. Stock buybacks go to the benefit of the stockholders because we own a larger piece of the company. And so you look at the cumulative effect of that over the last 20 years, and you can see this company's created about $8 billion worth of wealth. We believe over time that increase will create an increase in the value of the company. The company will be worth more, and that'll be reflected in share price. So we look at this as the company's had about an $8 billion increase in wealth to the shareholders over that period of time, much of which has been paid out to us directly already in terms of dividends. So this is a solid company, and we think it does a great job of creating wealth for the shareholders. So the final thing we're going to look at is how well we've performed as a portfolio. It's been a bad week or two. We were doing much better 2 or 3 weeks ago. However, the trade deal with China has broken down, which has caused the market to collapse. We're still doing okay. We're still profitable for the year, but we're significantly less profitable than we were 3 or 4 weeks ago. We look at that as being temporary. We think we like our companies and they're going to continue to perform. We'll continue to watch this trend, and if things continue to go poorly, we'll report back. But for now, right now, we're not going to spend a lot of time on how well we're doing because we think it's transitory that it's so low.